Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest instalment of our InvesTips series, which aims to provide some useful tips on different aspects of investing. Today is the 3rd of November and I'm Steve Brice, the bank's Chief Investment Officer. More and more indicators are flagging an elevated risk of recession. The latest indicator to add to the recession narrative is the inversion of the 3-month to 10-year part of the yield curve. Every time this has happened historically, it has been followed by a recession with an average lag of around 11 months. Please listen to our Cut to the Chase podcast of 31st of October entitled It's Scary Out There for more details on this. Of course, the R word can send shivers down the backs of even seasoned investors. Therefore, today I want to outline 3 key principles to think about when it comes to surviving recessions and thriving thereafter. So the first tip is to tilt towards more defensive investments, and there are 3 components to this: increasing cash holdings, allocating more to defensive areas of the stock market, and third, adding to higher quality bonds. So let's talk about these in each of these in turn. So a slight tilt towards cash makes sense as the risk of a recession increases materially. There are 2 advantages of holding cash during a recession. First, the risk of losing value in nominal terms is very low, and the recent rate hikes have actually increased the nominal returns on cash through obviously higher interest rates. Second, having cash on the sidelines creates some dry powder, which allows the investor to take advantage of assets when they get to depressed levels. However, it's still important not to have excessive cash, as this asset class can lose purchasing power if interest rates are below the level of inflation, which is still true today, and staying in cash too long can undermine long-term portfolio returns substantially. Just to give you some idea of potential weights to having cash, a conservative investor may want to have around 25% in deposits, while investors with a more moderate or moderately aggressive style might want 10 to 15 and 5 to 10% respectively. As far as the second piece of stock market investments are concerned, of course stocks often perform poorly during a recession. However, tilting towards a more defensive area of the market may help limit the downside. Potential areas to look at include healthcare, consumer staples, energy and utilities, where earnings may be more resilient in a recessionary scenario. A tilt to high dividend yielding equities may also make sense, as the income can cushion any capital losses and be reinvested into undervalued assets. Finally, as within equities, there are areas of the bond market that are more defensive than others. Investment-grade bonds, for instance, have lower credit risks than high-yield bonds. They also are more likely to benefit from the decline in risk-free or government bond yields as central banks ease monetary policy. Therefore, a shift towards investment-grade bonds ahead of a recession may reduce portfolio volatility and enhance returns. So that's the first area of tilting towards more defensive investments, whether it be cash, equities, defensive areas in equities, or higher quality bonds. The second thing you can do is use dollar cost averaging. So this is a time-tested approach for long-term investors. Now, in theory, a buy and hold approach would actually outperform dollar cost averaging strategies, especially if the money was deployed at the right time. However, we all know that timing markets is incredibly difficult. Meanwhile, a pure buy and hold strategy does not take into account our behavioral biases. So a dollar cost averaging approach can be a good way to manage your emotions when it comes to invest. When a markets are weak, the value of your historical investments naturally declines. However, a regular savings plan or dollar cost averaging plan helps remind you that you're buying investments at a discounted level during such periods. Psychologically, this can help you stay invested for the long term, which we see as key to long-term financial success. An investor can consider either a time-based approach, which is basically buying into the market at regular predetermined intervals, or a drawdown-based approach, buying after a significant market pullback of say 5% or 10%, or you can use a combination of the two. I think this is really a useful strategy when it comes to managing your own emotions, which is so key to investing. The final piece I want to talk about is diversification. So diversification, we continue to believe, is key. While 2022 has seen both equities and bonds lose value year to date, this is extremely rare, and we believe that diversification will still help investors stay invested over the long run by smoothing portfolio returns, especially in down markets. The fact that bond yields have already increased substantially increases the downside protection they are likely to offer during a recessionary period. Again, we see this as being critical to staying invested in the long run. Diversification really does help smooth returns. So to summarize, we have 3 tips when it comes to investing in recessionary periods. Tilt to more defensive investments such as cash, defensive equities, and high quality areas of the bond market. Secondly, employ dollar cost averaging to help you take advantage of markets as they go on sale. And third, ensure sufficient diversification to smooth the roller coaster ride that equity markets can provide. I hope that you find these tips useful as you plot your investments for the coming 6 to 18 months. That's all we have time for in this episode, but I look forward to talking to you again soon. Please take care and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.